Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Brad McMillan, Chief Investment Officer at Commonwealth Financial Network, to discuss the current decline we're seeing in stocks. And while sharp, it's fairly typical in market history. Brad, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me, Jill. Good to see you.
Thank you. And despite the real risks that are out there, the current bear market is not really just about the headlines. Help us put that into context.
Well, when you look at the bear market, you think of the headlines that we've been seeing. We've got the war, we've got inflation, we've got the political back and forth. I mean, there's any number of things to be worried about. But that's pretty typical. And we've seen that, and we've seen the market rise despite all those headlines in the past. So what's different this time? I would argue that it is the fact that the Fed is finally committing to getting inflation under control, that the Fed is finally turning their attention from employment, which is fine, better than fine, in fact, to inflation, which is now the bigger problem. And that really is different than where we've been over the past decade or more. So the market is struggling to react to, what does this mean for interest rates? And because of interest rates, what does that mean for stock valuations? So I would argue this is a story about interest rates and the Fed rather than the headlines.
Right. And Brad, when we look under the surface more with the economy, is there a potential for us to be in a recession, because the consumer is still somewhat quite strong? And of course, the housing market hasn't hit a bubble yet either, if in fact it will.
And that's exactly right, Joe, because when I get the question, will there be a recession? The answer is yes, 100% there will be. But when will it be? And I don't think it's going to be this year. And I think there's a reasonable chance we don't even get it next year. Because you mentioned the consumer. When you look at jobs, for example, we're adding 400,000 jobs a month. You don't see that in a recession. We're seeing consumer confidence. Yes, on the one hand, the Michigan survey is very low, but that actually isn't the best indicator of growth. And the Conference Board numbers are still actually quite strong, down from the crazy strong levels we saw, but still fairly strong. You don't see that in a recession. And I could say the same things about the yield curve and business confidence. In other words, all of the things that lead to a recession, none of them are there yet. Do we have risks? Absolutely. Do we see some slowing? Absolutely. But we've also got a lot of momentum, and that's going to help going forward.
Right. And Brad, to your point before, of course, it's about the headlines. I mean, recessions make for sexy headlines, particularly in a midterm year. But recessions at the end of the day are part of the natural business cycle.
And that's exactly right. Again, because what we see here is we've seen a tremendous amount of stimulus dumped into the economy, and that's led to inflation, that's led to more growth. And then we've seen a lot of other things that have been tailwinds. And at some point we have to account for that. We have to kind of get the excesses out of the system. And that's exactly what the Fed is trying to do. And this is something to lay the groundwork for future growth. It has to happen, and it will happen. Is it fun? No, it never is, of course. And the same thing with the markets. Markets were very pricey. They're starting to revert to normal. Is this fun? Absolutely not. But is this necessary to lay the groundwork for the next phase of growth? I think it is. And I think once we get through this, we're going to be happy with where we are in a year or two.
So at the end of the day, if you put on your longer term investment hat, if you will, should investors keep calm and carry on in this kind of environment?
I never take off my long-term investor hat. So, I look at this and my question is, what has changed in your expectations for the next 5 years, the next 10 years? If the answer is nothing, then you really should just stay with the program. If you're still investing, there's a chance to buy stuff at a discount. If you are in your retirement phase, well, okay, those fixed income investments are going to yield higher returns going forward. And we're still going to see growth. So keep calm and carry on. Couldn't have said it better than Queen Elizabeth myself.
All right, Brad, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.